Over the last 3 years, something unprecedented has been happening. The world's biggest holders of US debt have quietly started selling. China has dumped more than $340 billion in US Treasury bonds. Japan followed. Even longtime allies like Britain and Germany are stepping back. And all of this is happening while America owes $34 trillion. $34 trillion. That's not a typo. That's what America owes right now. More debt than the entire European Union, all of Africa, and South America combined. And here's the terrifying part. It's growing faster than ever before. For nearly a century, lending to the United States government was the safest bet on planet Earth. Safer than gold, more reliable than any bank, the bedrock of global finance. But something has shifted. Since 2021, China has quietly sold over $340 billion in US Treasury bonds. Japan, America's closest ally, has followed suit. Even Britain and Germany are stepping back. The world is slowly, methodically, walking away from American debt. And when the world stops buying, the consequences won't just hurt Americans. They'll reshape the entire global order. This isn't conspiracy theory. This is math. This is history. And this is happening right now. The illusion of infinite credit. For most of modern history, the United States operated under a simple but powerful assumption. They could borrow without limit. Whenever Washington needed money, for wars, for stimulus, for bailouts, they simply issued bonds, and the world lined up to buy them. Tokyo, Beijing, London, Frankfurt, Riyadh. Every major capital held American debt because everyone believed in one fundamental truth. The dollar would never fail. This wasn't blind faith. It was built on decades of stability, military dominance, economic output, and institutional trust. When you bought a US Treasury bond, you weren't just buying a financial instrument, you were buying into the American system itself. And that system, for all its flaws, delivered. Interest payments arrived on time, every time, without exception, for generations. But trust is a finite resource, and when you owe $34 trillion, trust starts to crack. Here's what most people don't understand about sovereign debt. It's not like household debt. Countries don't go bankrupt the way companies do. They don't liquidate assets and close down. Instead, they face something far more insidious, a slow erosion of confidence that manifests as rising borrowing costs. When lenders doubt your ability to repay, they demand higher interest rates. And for a borrower, as large as the US government, even a small rate increase means hundreds of billions in additional annual costs. Right now, America spends over $1 trillion per year just on interest. Not on schools, not on roads, not on defense, just interest. That's already more than the entire military budget. And if rates keep climbing, if foreign buyers keep retreating, that number will explode. The world is starting to ask a question that was unthinkable just a decade ago. Can America actually afford this debt? The era of free money. To understand how we got here, you need to understand what happened after 2008. The global financial system nearly collapsed. Banks failed. Credit froze. Panic spread. And the US government did what it always does in a crisis. It spent. Massively. $700 billion to bail out Wall Street. $831 billion in stimulus for Main Street. Tax cuts, infrastructure, direct payments. All of it borrowed. All of it added to the national debt. From 2008 to 2020, America's debt load increased by more than 30%. By 2020, every man, woman, and child in the country technically owed around $80,000. But here's the crucial detail. Borrowing was essentially free. Interest rates on U.S. debt hovered near zero. The cost of servicing all that debt was negligible. Why? Because the world still trusted the dollar. In times of crisis, investors didn't flee from U.S. bonds. They ran toward them. This demand kept rates low, making the debt burden manageable despite its size. It was a perfect arrangement. As long as confidence held, America could borrow trillions without paying much for the privilege. Of course, this strategy had a massive vulnerability. If rates rose, if confidence faltered, the math would turn ugly fast. Every 1% increase in interest rates would cost the government an extra $280 billion annually. But in 2020, nobody was thinking about that. Everyone was thinking about survival. The pandemic accelerator. When COVID-19 hit, the economy didn't just slow down, it stopped. Millions lost jobs overnight. Businesses shuttered. The government faced a binary choice: spend trillions to prevent total collapse, or watch the economy implode. They chose to spend. Stimulus checks, unemployment extensions, business loans. Trillions poured into the system in months. By the time the dust settled, the national debt had jumped by more than $5 trillion. That's an extra $15,000 of debt for every American, added in less than 2 years. And for the first time since World War II, America's total debt exceeded 100% of GDP. What had once seemed like a manageable burden was now spiraling out of control. Here's where the cracks started showing. The entire global financial system was built on one core assumption: US debt is risk-free. That's why pension funds in Tokyo held it, why sovereign wealth funds in Abu Dhabi accumulated it, why central banks in Frankfurt kept it as reserves. But when debt grows this fast, this large, investors start to question whether it can ever actually be repaid. And questioning turns into action. The Great Retreat. In late 2021, something subtle but significant happened. China, which had spent 2 decades accumulating over $1 trillion in US Treasuries, started selling, not in panic, not all at once, but steadily, month after month, quarter after quarter. By 2024, China had offloaded more than a quarter of its holdings, $340 billion worth. Japan, the largest foreign holder, trimmed its position by over $200 billion. Even traditional allies like the UK and Canada began reducing their exposure. Financial analysts offered explanations: currency defense, portfolio rebalancing, domestic needs, all technically true. But patterns reveal deeper truths. When multiple major holders simultaneously reduce positions, when the selling continues for years, when even close allies start backing away, it signals something fundamental: a recalculation of risk, a reassessment of what safe really means. And the reassessment is based on simple arithmetic. America now owes more than its entire economy produces in a year. Every citizen technically owes over $100,000, and every year, the government must find buyers for trillions more in new bonds just to keep operating. What happens when buyers become scarce? The interest trap. The first consequence is already visible: exploding interest costs. The US government currently pays around $3 billion per day just to service existing debt. That's the highest level in American history. And as foreign buyers retreat, rates will rise, making that burden even heavier. Over the next decade, interest payments alone are projected to cost each American over $40,000. Money that could fund healthcare, education, infrastructure, or tax relief will instead flow to foreign governments and institutional investors around the world. Think about that for a moment. America spends 18% of all tax revenue just on interest payments, almost double any other G7 nation. France and the UK keep their debt servicing below 10%. Even Greece, a country that nearly collapsed under its debt burden, only spends about 5%. America is now dedicating nearly 1 out of every 5 tax dollars just to pay interest on past borrowing. And as confidence continues to erode, this burden will only grow. But it's not just the government that faces trouble. A debt crisis triggers a cascade of consequences that hit ordinary people in ways most don't see coming. The currency spiral. Here's the mechanism most people miss. When investors buy US Treasury bonds, they need dollars to do it. High demand for bonds means high demand for dollars, which strengthens the currency. But in a massive sell-off, the opposite occurs. Foreign investors dumping Treasury bonds aren't just selling debt instruments. They're also selling dollars, converting them back into yen, euros, yuan, whatever currency they actually use. More dollars flooding the market. Fewer buyers wanting them. The value drops. And this is where ordinary Americans feel the pain. The US imports $4 trillion worth of goods annually. That's a quarter of all manufactured products and a fifth of all food consumed domestically. When the dollar weakens, imports get expensive. Fuel, groceries, electronics, medicine, clothing, everything. Suddenly, the cheap credit that powered American consumption for decades becomes a liability. The standard of living people took for granted starts eroding, not through some dramatic crash, but through a steady, grinding increase in the cost of living that wages can't keep up with. The Venezuelan mirror. History offers a chilling parallel. 20 years ago, Venezuela was the wealthiest nation in South America. Massive oil reserves, booming economy, a government flush with cash. International investors lined up to lend. Everything seemed unstoppable. But beneath the surface, the country was building a fragile structure. Too much dependence on oil exports, too much borrowing, too much assumption that the good times would last forever. Then oil prices collapsed. Revenue vanished. Investor confidence evaporated. Almost overnight, Venezuelan bonds became toxic. The currency crashed. Inflation spiraled out of control. Within a few years, people needed wheelbarrows of cash to buy bread. 2 decades later, inflation still exceeds 100% annually. Venezuela's collapse was devastating, but a similar crisis in the United States would be exponentially worse. America isn't just another economy. It's the foundation of global finance. The dollar isn't just another currency. It's the reserve asset backing the pound, the euro, the yen, dozens of others. If confidence in the dollar shatters, it doesn't just hurt Americans. It destabilizes the entire planetary financial system. The reserve currency dilemma. For almost 80 years, the US dollar has been the world's reserve currency. When central banks hold reserves to stabilize their own currencies, they hold dollars. When oil trades internationally, it trades in dollars. When countries settle debts with each other, they often settle in dollars. This arrangement gives America enormous advantages. It can borrow cheaply, it can run persistent trade deficits, it can impose sanctions that actually bite. The reserve currency status is the foundation of American geopolitical power. But that status depends entirely on trust. Trust that the dollar will hold its value, trust that the US will honor its obligations, trust that American institutions remain stable, and trust is eroding. Tariffs create uncertainty. Inflation undermines purchasing power. Endless debt accumulation raises questions about sustainability. Other nations are already hedging. China is aggressively promoting the yuan in international trade. Some countries are settling transactions in euros, gold, even cryptocurrencies. The rise of alternative reserve assets won't happen overnight. But once the process starts, it's difficult to reverse. And if the dollar loses its dominant status, America loses its ability to borrow cheaply, run deficits without consequence, and project power globally. The impossible choices. So what can be done? America faces two options, neither attractive. Option 1, cut spending dramatically, reduce the deficit, stabilize the debt. This is the responsible path, the one economists recommend. It's also political suicide. Cutting spending means cutting programs, Social Security, Medicare, defense, education. Every dollar cut affects real people. Voters say they want fiscal responsibility until it touches something they care about. Since 1980, the US has run budget surpluses in only 4 years. Every other year, the government added to the debt. Both parties, every administration. Recent efforts to cut wasteful spending have generated headlines but minimal results. Projected savings of $40 billion sound impressive until you realize that covers barely 10 days of interest payments. Even the most ambitious targets, saving $1 trillion over years, would barely dent the structural problem. The reality is that most federal spending isn't bureaucratic waste. It's Social Security, Medicare, defense, and interest on existing debt. Without touching these, deficit reduction is impossible, but touching them is political death. Option 2, print money. The Federal Reserve can create unlimited dollars. In theory, the government could print its way out of the crisis. In practice, this would be catastrophic. Investors bought US debt believing it was a safe store of value. If the government starts printing money to pay obligations, that trust disintegrates. The dollar loses value rapidly. Inflation accelerates. Foreign creditors dump bonds en masse, driving borrowing costs through the roof. This wouldn't just be a crisis. It would be a full-scale collapse. A betrayal of every investor, foreign and domestic, who ever trusted American debt. Neither option solves the problem. Both create new catastrophes. And time is running out. The human cost. Behind every statistic is a human story. Behind every percentage point is someone's life being squeezed. Consider retirees who saved diligently for decades. They invested conservatively in bonds and fixed income funds, exactly as they were told to do. For years, this worked perfectly. But now their bonds are losing value as interest rates rise. Their fixed income buys less as inflation persists. They followed every rule, and yet their security is evaporating. Or young families trying to buy homes. Housing prices have surged. Mortgage rates have more than doubled. The monthly payment on a median-priced home now consumes more than 40% of median income. They have stable jobs. They've saved for down payments. But the math simply doesn't work because government borrowing is pushing rates up across the entire economy. This is the cruelest aspect of a debt crisis. It punishes the prudent and rewards the reckless. People who borrowed heavily with fixed-rate mortgages are protected. People who invested in stocks and real estate have seen their assets inflate. But people who kept savings in conventional places, savings accounts, bonds, certificates of deposit, are watching inflation devour their wealth. It's a silent transfer from those who followed the rules to those who took maximum leverage. And it happens because a government drowning in debt creates inflation, either overtly through money printing or covertly through financial repression. The imperial pattern empires don't collapse overnight. They erode through compromises. Rome didn't fall when barbarians sacked the city in 410 AD. That was just a symptom. Rome fell because it could no longer afford its armies, roads, borders, and population all at once. The empire grew too large, too complex, too expensive to sustain. Spain didn't lose its empire in a single defeat. It bled out through a century of wars funded by American silver that generated inflation instead of wealth. By the time the wars ended, Spain was economically exhausted and geopolitically irrelevant. Britain didn't lose its empire because it lost World War II. It won, but the war bankrupted the country. By 1945, Britain owed more than twice its GDP. It couldn't maintain colonies, fund adequate military, and rebuild at home, so it retreated, granting independence territory by territory until the empire existed only in history books. The pattern repeats because the logic is consistent. Empire is expensive. It requires military power, diplomatic influence, economic leverage, technological superiority. When costs exceed capacity, choices must be made, and every choice involves surrender. America today faces its own version of this dilemma: global military presence, alliance commitments, reserve currency status, technological edge. All require sustained investment, all cost money, and all become harder to maintain when the government spends more on interest than on defense. The unanswered question. We're living through the opening act of a transformation that could reshape global power structures in ways unseen since 1945. The question isn't whether America will collapse. It won't. The question is what it becomes when it can no longer borrow without limits, project power without consequences, or assume its central role in the world order. History suggests this shift happens slowly, then suddenly. Trust erodes gradually until a critical threshold is crossed. Then the change accelerates beyond anyone's ability to control. Are we approaching that threshold? Is the slow retreat of foreign buyers a temporary adjustment or the beginning of a fundamental realignment? Can America find the political will to make brutal but necessary choices before it's too late? Or are we witnessing the early chapters of the story future historians will tell about how the world's financial hegemon lost its crown, not through conquest or catastrophe, but through simple arithmetic it refused to acknowledge until the numbers became undeniable? One thing is certain: the assumptions that held for 80 years are being tested in ways they haven't been since the system was created. And what emerges from this test will determine not just America's future, but the shape of global power for generations to come. The debt won't disappear, the interest won't stop accumulating, the choices won't become easier, and the world is watching, calculating, and quietly preparing for a future where American dominance is no longer guaranteed. What that future looks like depends on decisions being made right now, and on whether those making them truly understand what hangs in the balance.